The next 90 days could potentially make you millions of dollars in the stock market. So let's break everything down right here. You're essentially going to know all the stuff going on in the market right now, all the good, all the bad, and how to capitalize on this because there's a lot of fear out there right now. And you can see just by looking at the fear greed index right here, it's 23, which is the extreme fear category. So there's a lot of people freaking out. The market's on a little bit of a dip. Companies like Palantir and Tesla and Nvidia, they're all down a lot more than what the overall market is down. So everybody wants to know, do we buy the dip or is the market going to keep going down lower and are we going to potentially catch a falling knife? So let's take a look at the emotional aspect of the stock market. So basically we'll just flow through this in my newsletter that I typed out, all this stuff right here we're going to go through. But understand that by the time we get to the end of the video, you're going to have a very good idea about what's exactly going on in the stock market right now and potential upside that we could have and potential downside. So back to the fear greed index right here, we're in the extreme fear category. And the best investor of all time, Warren Buffett, he basically says when there's fear in the market, that's when you want to be greedy. So right now, there's definitely fear in the market. So this is a time that we want to be greedy. And I'm going to show you a chart in just a second that really depicts this very well. That when there's fear in the market, everyone's writing the negative news articles. All the people are texting you saying, oh my God, the market's down. Do I sell everything or what do I do? That is a time that you want to start to become bullish. Now, I'm not saying to buy the dip and YOLO calls at this point right now. By the end of the video, you're going to know what to do. But what I am saying is things are cheaper right now than they were a couple months ago. So if you liked Tesla, for example, when it was 475 bucks a share or whatever it went to a couple months ago, why would you not like it right now and it's 250 bucks a share? It's the exact same company. So understand that yes, there's fear in the market, but short term, that's how the market moves. It's just fear and greed, but it doesn't necessarily correlate to exactly what the underlying businesses are doing when we see all this fear, greed, and market volatility. So let's just look at Tesla chart right here, for example. So you can see over here in this pre-election period right here, we went from roughly, low 200s and we peaked out all the way. I know it says 436 right here, but it actually went to about 480 per share. And now it's at 248 per share at the time of recording this. So my question to you is this. Did the value of Tesla materially change going from roughly 220 to just say 440? That's a double. Did the actual underlying business double in value? And then did it go half in value when it went all the way up to here and then all the way down to here? The answer is no, but it's just fear and greed in the market. It's just people pumping stuff out of the wazoo, but it's not justified. So when Tesla was up here in this period right here, this needle over here was close to the greed and extreme greed category. So in the extreme greed category, that's when everyone in the wazoo is texting you saying, oh my God, I just YOLO call options on Tesla. And that's the exact wrong time to do it. So you want to start to be bullish when we're in the extreme fear category right here. Now, if we go down a little bit, interest rates are like gravity on the stock market. So we're just going to continue to flow through this report right here. So last Sunday for the 10-year bond, they were at roughly 4.3%, and now they're at 4.25%. And I know this might not seem like a lot to you, but it actually is very, very important because money wants to find the best risk-adjusted return. So if you could get a risk-free rate of return in a bond for, say, 4.25%, or a risky rate of return in the stock market for 10% at a time that we have tariffs, at a time that we have inflation potentially coming back, recession potentially coming, and interest rates are everything to the stock market because money wants to find the best risk-adjusted return. So just think about it. If you could get a guaranteed rate of return of 4.25% right now in a bond, which is what it is, or you could get a risky rate of return of roughly 10% in the stock market, and understand that the stock market, right now, maybe we're a little bit overvalued. There's tariff threats, potential recession threats. There's a lot of trade war fears going on and all this crazy stuff that we'll go through in just a second, and how it actually could be really good for the market that nobody's talking about. But, to some people, it's compelling to just go put their money in that bond and get that guaranteed rate of return and just kind of sit on the sidelines and weather out the storm. So, rates are going down on bonds right now just a little bit week over week. So that makes it more compelling to go put your money in the stock market. Because let's just do an extreme example right here, just so you can really understand how this dynamic works. Let's say the bond yield was 1%. So that's 1% per year. Are you going to waste your time in a bond getting 1% a year that doesn't even beat inflation? And when you get your little 1% return, you have to pay taxes on it. Most people aren't going to waste their time doing that. So they say, okay, I'm going to go pile my money into the stock market. But as bond yields, they crept up a little bit, the stock market went down, which is what you saw in 2022. So now bond yields are starting to fall, which is good for the market because this is becoming less compelling. Less people want to put their money into a bond. And that's kind of what I talked about right here. Now, if we go down here to the breakdown, understand that there's a lot of things that are happening in the market right now that are both good and both bad. And the thing that I really want to go into in just a second after I basically just feed you this information so you know like the context of what's actually going on, I want to talk to you about a scenario that is extremely bullish for the market that is probably going to play out in the next 90 days. That honestly, you have to know. I don't think there's a lot of people right now talking about this. I'm not like clickbaiting you to watch till the end of the video, but you just have to understand what's going on right now to know how that potentially is going to play out. So let's look at this chart right here super quick. So this purplish line right here corresponds to the NASDAQ, which is down roughly 6% year to date. And the other line right here that goes green and then red right here, that's the S&P 500, which is only down 3.4% year to date. So everyone that's freaking out and panicking, and they're sending this fear greed index into the extreme fear category, it's like, what are you really talking about? Because we only fell, just a few percent. And then you can see what I say right here, that I feel like the needle is truly at 50, not at 23, because I feel like this is overblown. I feel like there's just so much fear in the market, and it's not actually justified. Because look, we only fell this little bit right here, and it's very likely that the market is eventually going to rebound out of this potentially this year or even next year. But if the scenario plays out that I'm going to talk to you about in just a second, it could rebound in the next 90 days and it's going to be actually really crazy. So, of course, the hot topic on the street is tariffs. You could go through and read all this if you want. But one of the key things that you have to worry about with tariffs right now is I feel like Trump is kind of bending the knee. And as the weeks go by, every single week, I think that there's going to be a chance that tariffs aren't going to end up as bad as what we actually think. And understand that, this whole market dip is basically around tariffs, with everyone basically freaking out saying, well, cost of goods is going to go up. That means inflation is going to go up. That means the Federal Reserve is going to keep interest rates higher for longer or potentially raise interest rates. That's going to make people spend less money. And the United States economy is a consumer based economy. So all this negative feedback loop stuff is potentially going to happen. And that's sending the stock market straight down. Now, the scenario that not a lot of people are talking about right now is this idea that there might be reciprocal reduction of tariffs. So on April 2nd, Trump is apparently going to raise our tariffs to basically what every other country's at. So when we import a car into our country, maybe the tariff is at 0%, but when we import a car out of the country, something we make in America and send to Canada, for example, maybe there's a 25% tariff or whatever it may be. So he's basically going to make everything a level playing field. And I think it would be really hard for a country like China, or really any of the countries that we trade with, to be like, yeah, we're at 25% and you're at 25%, but we're going to retaliate because we want to be higher than you. I think that that would kind of be like negotiating in bad faith, and really, I think that would come off really bad. So I don't expect massive retaliations with these tariffs. But what I do expect to happen once these tariffs go into place is that all these countries want to see if Trump's actually going to do it, number one, which I do think he actually is going to do it. But once he does it, I think that they're going to do reciprocal lowering of tariffs. So they're going to be like, we're at 25, maybe let's go to 20 and then 15 and 10 and see how things go. And if that scenario truly, truly plays out, just think about it. That is going to get passed on to the consumer, lower prices, but that's also going to be passed on to the companies itself. Because when something comes into America that's, say, a 25% tariff that the US government charges, the price of that is usually going to get passed on to the consumer, meaning us, that we buy that stuff. But if the tariff goes to 0%, maybe that company says, okay, we're going to pass a little bit of that onto the consumer, which is maybe just say a 5% price reduction, which is good for inflation to go down. But the other 20%, where does that money go? That's going to go in the pocket of the actual company itself. So understand that the earnings per share, the bottom line of these companies, could go way up if the tariffs go down, because it's basically money that the government's not going to get, and a part of that's going to go to us in the form of lower prices. But the majority of that is probably going to go to the businesses in the form of more earnings, which could potentially send the stock market basically straight up. And the stock market's a little bit beat up right now, but companies like Tesla are super beat up in price right now. And this is a very interest rate sensitive company right here. Because if you could go buy a car at a 0% interest rate versus, say, a 5% interest rate, more people are going to be willing to go buy that car at a 0% interest rate. And also understand that a lot of these car companies, they subsidize the interest rates. Maybe it's supposed to be 5, but then they buy it down to 2% for you. Understand that, Tesla is eating that cost. So when they don't have to eat the cost anymore because inflation's going down, which means the Fed lowered interest rates probably to just keep the economy going pretty strong. And, the Fed's job is to keep the economy strong, but keep inflation low. So there's no need to keep interest rates high if we have no inflation. So as interest rates go down, the gross margins for companies like Tesla, and really a ton of companies out there that borrow money or lend money, they can make a lot of money doing that stuff. So as interest rates come down, companies like Tesla's gross margins are going to go way up. And, this really affects every single company out there, to be honest with you. This could actually be bad for bank stocks, but then, they would get more money with refinances and stuff like that. But the net interest margin, meaning they borrow money for, say, 2% and they loan it to you for 4%, that gap of 2 to 4 is going to get more slim as interest rates go down, if they do go down. So some companies will benefit and some companies will not benefit. But I think overall, companies like Tesla that are interest rate sensitive, I think they'll do very, very well. Potentially companies like small cap companies, they'll do very well too. And before we wrap this up, I want to show you this chart right here and one more chart just to show you how well the market is correlated to fear out there. So the orange line right here corresponds to the S&P 500, and the blue line right here corresponds to the fear greed index. So the lower the numbers are right here, this means there's more fear in the market. So if we go back up to the top right here, we are at 23, extreme fear. And if we go down over here, that corresponds to this level over here. So roughly 23 at this tip right here. Now, what's funny is that when there's peak fear in the market, when everyone's freaking out, when everyone wants to sell their stocks, look at how accurately that potentially timed the bottom of the market. I'm not saying this is going to work every time, but understand that, dip right here, extreme fear. Dip here, fear. Dip, fear. Dip, fear. I mean, corresponds pretty well. And of course, the market could go down a little bit more, and I'm going to show you the chart here in just a second that shows you that. But, when there's fear out there in the market and you see all these people on YouTube and on X fear mongering you and telling you to sell everything, there's a lot of YouTubers that I follow and watch their videos too. And, they have big followings. And, I know their followings listen to what they have to say. But when you really sit there and say, does this big YouTuber truly make millions of dollars in the stock market with stocks and options? Most of them do not. I personally do. I practice what I preach. That's why I'm just here to give you guys value. I don't care if these videos get views. I'm just here to lay it out there for you and be honest with you. I'll talk about this real quick right here, the Federal Reserve. So basically right now, interest rates are at 4.25%. If we do end up going into a recession, the Fed could just lower interest rates to zero. So 4.25 to zero could happen overnight. That's what happened with COVID. The stock market was at rock bottom long before COVID, really finished up and things actually opened up in the economy. So what I'm getting at is once the Fed said they're going to cut rates to zero, and they actually did, and they started printing money, the market went straight up, and COVID still had months to go. So understand that we do have quite a bit of ammo if the economy takes a crap. We could just cut rates to zero and it'll support things quite a bit. You'll want to go buy a car and you'll maybe go buy a house because rates are so low. Now, this is one of the important charts right here. And then the last one right here we'll go into in just a second. This right here shows you overall that the PE ratio of the S&P 500 is coming down a little bit. You can see this dip right here. That is good. Historically, we're still a little bit expensive. I mean, I'm not going to lie. The market could come down quite a bit more. And the average is roughly 15.8 to be precise. And right now we're at 20.5. So this corresponds to roughly, a 25% drop that we could go down a little bit more. But understand that interest rates in this time period right here are, a little bit lower than what they were in this period over here. So as interest rates get lowered, market valuations typically go higher. So we're a little bit overvalued, but I don't think we're a bubble. But here's the thing that really matters the most. This is the S&P 500 chart on the lighter line, and the earnings growth is this straighter line that looks like that right there. And these two lines right here will touch at some point in the future. I don't know when they're going to touch, but they will 100% touch. So either the stock market has to fall down or the earnings of the companies within the S&P 500 have to go up. One of those two things will 100% happen. I could promise you that. So, we're still a little bit overvalued, but if this scenario plays out like I just talked about, there's a good chance that earnings could go pretty much straight up and have a little, bump like this right here. And then I would say the market is pretty close to intrinsic value overall. So if that happens, if we actually get reciprocal reduction of tariffs, I think the market's going to go straight up. I think that people are going to be really upset that they were very, fearful right now, which you could see right here. People are freaking out. There's hedge fund selling. There's a lot of people on the sidelines. There's so much money on the sidelines right now. I read what everyone says on X and watch the YouTube videos. There's a lot of fear out there right now, but that's a good time to be bullish. So if you want to learn how to capitalize on the stock market, win with stocks, win with options, click the link below, get in my course. It's 60% off right now. But if you don't want to do it, watch this video right here. It's going to go a little bit more into stock options. I'll see you guys there.